No. Hey, I saw myself on television for the first time. Did you do that?
Oh no, I missed it. You were out last weekend?
Yeah.
Well, I
Have you
saw.
seen yourself though?
Yeah, I did.
You did.
Yes. I
How
saw
was
my
it?
parents and they said, we wish there was more of you.
Wow. Like, is that like a little jab at like eat more? You're too skinny?
No, not width or vertical wise, but more time. It was too short. It was like 2 minutes.
I know. Thank the Lord, man.
And what
We're
did you think? Were you happy with your
we have faces made for radio or podcasts.
you were happy with the result of how it turned out?
Yeah. I think they do a good job and they made us look
Oh, wait,
semi-competent.
hold on. Oh, you saw Marcos on TV? Yeah, hold on a second. I'll see if he's available. You know, I have another viewer calling in for you.
Oh my God. Not,
He's
not the
busy.
call line again. Not the call line. I can't believe they're having all of our calls redirected straight to you.
What? No. Every Harry Sick and Jelly's got $10 is calling me. You said you could help out anybody. I got $10. What can you
We
turn
should
in?
do that take live call. Long time listener, first time caller. Brett, love you, man. Loved you in episode 20. Hello and welcome to episode 33 of Talk Your Chart. I am Marco Segrera, along with my partner, Brett Horowitz. Brett, always a pleasure to see you. Today, we kick things off April 19th, 2023. Earnings season is on the way. Earnings have been, drum roll,
Bad.
not as bad. Did you say bad?
Bad.
No, they
Well,
haven't.
compared to a year ago, yes.
Oh, you better have a chart to show that, buddy. They're not as bad as expected, though, which is all that matters. So there you go. I don't care what it looks like last year. I want to know what expectations were and if they were exceeded or not exceeded. We can say, though, the usual 75% beat rate, it's a little bit lower than that. So yes, not good relative to historical beat percentages, but not as bad as things expected. So what does that mean? Recession this year, next year? Where's the earnings recession? Does that give us a longer run to this little recovery that we're in? I have no idea. But Mr. Horowitz, I think there are a few questions on everyone's mind about what's driving markets. They are, of course, unanswerable for some extent, but I'm gonna lay it out here, and you tell me if there are any questions that you think are important that I'm missing. Number one is demand. How's demand? Is it waning or not? How's inflation, which I have a chart? How are supply chains? What are the plans for hiring, not just what it looks like right now? And how are borrowing and lending conditions? I think those are 5 big questions.
Good, not so bad, hot. I forgot the last two.
Okay, I like that though. That was good. That was good. Plans
Last
for
one is-
hiring,
Last one is
borrowing,
cooler.
lending.
Yeah, cooler for the last one.
Definitely cooler. Excuse me. Definitely cooler. But yeah, I have no idea. Plans for hiring? What do you mean hiring? Everyone's firing everyone, right? Walmart's firing, Amazon's firing, people are getting fired left and right, but not really.
No.
Not really. All right, what do you got for us? I have a CPI chart, but I'm going to hold that.
Well, let's talk about the fact. I got one stat for you that I'm hoping is an optimistic stat before I get into my charts. I told this to you yesterday. I thought it was very interesting. Going back to 1982, there have been 6 times where the Fed has stopped tightening interest rates. 5 of those 6 times, the market has rose at an average of 19% in the 12 months after Fed funds rate has peaked. So if we're talking about maybe Fed funds peaking here with one more hike in June, 19%, not so bad.
Fed funds peaking. Couldn't we get, okay, I'm just trying to think of the lagging effect, right, that comes into place. So here's my only issue with Fed funds peaking. Historically, you need to have an effective Fed funds rate that's above or at the rate of inflation before you can turn around. And right now, depending on what you're looking at, right, we got a 5.6% CPI, and we have a 4.8 Fed funds. So are we there yet?
We're getting close. Keeps coming down every month.
Yeah,
Inflation.
you're right. We're close. We're absolutely without a doubt close. And you know what? Let me let's check in on, I'm going to skip your chart. Let's go to my chart because we're talking about it
But
already.
didn't we both predict by the end of the year that inflation would be below the Fed funds rate?
Probably. Oh, wait a second. Let's go to it and see what we predicted. I think we look, I think, yes, I think we both said that. But coming off highs like that, I think it was pretty easy for both of us to say it. You said inflation at 3.2. I said inflation at 3.4. I kind of prices righted you on that one, didn't I?
And where's Fed funds rate in those situations that we said?
Oh, we did that too, didn't we? We didn't predict Fed funds. How silly of us.
No, we just did the 10-year only.
Yeah, we just 10-year. We should
Ouch.
throw in a Fed funds prediction, even though we're kind of cheating. Maybe next year.
Higher than 3.2. I'll go with that.
Oh, nice one. Very good. What a savant, this guy. Yeah, so 3.2, and right now, so look, let's bring up my chart first. Looking at this, there's a lot of colors on here, mainly shades of yellow, red, and green. In this case, red is bad, blue is good, negative is good, positive is bad. Looking all the way to the right, you follow 2023 and then MAR, which stands for March, last I heard. We have annualized headline CPI at 5.0, core CPI at 5.6. That's the one that's making everyone kind of nervous. Here's what I thought was interesting is they started plotting on this chart, which I love, the core services ex housing PCE, personal consumption expenditures deflator, at 4.5%. What is this thing? So it's a hell of a name for the data point, but it reflects the custom PCE index of services, excluding energy and housing, referenced in the Federal Reserve's monetary policy report. It's the one that they're looking at and supposedly taking their cues from more than the others. Whether that's true or not, I have no idea. I haven't texted with Jerome in a while. So if that's coming in at 4.5, that's nice. Here's, look at this. So watch, ready? Keep going down, Brett, from 4.5. Keep going down to the monthly now. Go to that same core services. PCE is at 0.3 right now. Compare that to June of last year. It was at 0.6. That's a 50% drop, right or wrong?
Yeah, it's in the direction it needs to go. I mean, I don't know
Exactly
who spends money not without counting food and housing, which tend to be the biggest amounts that we have. But you're right, it's where it needs to go. Everyone was pretty sure that these would come down over time because the Fed did their job and it has their eye on the ball the entire time. I mean, even with the banking situation from a few weeks ago, they said we're not stopping what we're doing. We're going to continue to increase rates because we have not gotten inflation to be where it needs to be.
Yeah, it still feels like they're going a little too strong. Everyone's talking about for the past few months, commercial real estate, that's going to implode, explode. We're still waiting. We're still waiting for opportunities to throw some cash at stuff. So anyways, that's inflation.
But you can't blame them too much because the jobs numbers have come down the last few months. We're still hiring, but it's not like we're not losing jobs, but we're not gaining jobs at the 500,000 pace that we were in January. And everyone said that at some point when rents turn over from a year back, when everybody was raising rents by 10%, you'd see these in the numbers, you'd see some big drops month over month. And we're starting to see that. So I don't think that the Fed is doing anything right now for a lot of people to say, you're wrong, you're doing it too fast. I know there's some people who are always going to say that, but the numbers don't support that we have an imminent, flashing red signal in front of us.
Yeah, I don't disagree with you. We still got 9.9 million job openings, and that's down from a high of 12 million. So also, like you said, in the right direction.
I mean, part of the reason that housing is still a problem, and I've got a chart here showing it, is that we're still forming more households than we are building houses. And
okay, but wait a second. For the viewer out there, define household formation.
I would assume that's babies.
Oh, no. So it's my understanding of household formation is, let's say you and I are roommates. And now because we get to work remotely, I decide, you know what? I can go live. I don't have to work in New York anymore and be a roommate. I'm going to move to Minnesota and live
Right,
in a 1 bedroom. So now I formed a new household because I moved out of you.
right. Could be kids moving out from their parents, or yeah, roommates separating, or just people being born that finally need houses at some point.
People being born, you're saying like a 6-month-old's like, I got to go get a place, Mom.
Not right now, but eventually they turn into a household.
Fine.
Versus the houses that they're building, the starts, all the houses that they're putting on land. And so you've
Yes.
had over the last decade, other than a few times here and there, lots more households being formed than housing starts.
Yeah, that's got to figure it out. We also have, it's completely unaffordable on a monthly basis if you look at the housing affordability index. And then the other thing that has to play a role is people can work from wherever they want now. And you're not going to leave your 3% mortgage. No one's going to do that.
Well, when Eleni starts to look for a new household, then we know that we've really got problems.
She's not even 2 yet, Brett. Okay. She's not looking for a condo on Brickell.
But you know what's also odd? I mean, Miami's always in the news. They were in the news this morning again for having the hottest market of the last year. I don't see that changing anytime soon. But the fact that people can sell their homes at such high values, like you said, it's some people are forced to do it, but the prices are not going down whatsoever. In fact, the article was saying that lots of the hot areas that were hot a year ago are going to see declines, and they expect Miami to be just flat because all the people just moving here from usually the Northeast.
Okay. I'm looking at your second chart now.
Yeah, let's talk about retail sales, because that's
Okay.
another one that I think, to me, the sort of the overall headline to me is much more damaging than what's actually happening. Retail sales are compared month to month. And so when they say for the month of March, buyers cut back in March, and we're a little bit down in January compared to where they were in February and March, compared to where they were in January. Like, look how strong January was. That was the month where everyone said, oh my God, inflation is back, because we had everything was popping in January.
Okay. Let me ask you this.
Mhm.
That March is being compared to February and that February is being compared to January.
Right.
Okay. Yeah. So they're just, it's making up, right? It kind of smooths itself out. Cause yeah, that's a big blue line in January.
But you also can't look at all the gray lines that are negative and say, my God, what's happening with the economy? Because we've had a lot of gray lines over the last couple of years down here, and the economy's been just fine over this period of time. When you're comparing
Fair.
it month over month, right, you're going to have ebbs and flows.
Yeah, I wish this chart went further just because that's still post-COVID stuff. Like I wonder what it looked like pre-COVID, given all that's kind of changed. It's also fair to say that that's a percent change as compared to the previous month. That doesn't mean that there's negative spending.
Right. Correct. Exactly.
Yeah. So that's probably important to understand when you look at that.
Yeah, you see the negative spending in a recessionary environment when you really had people hoarding cash at that point because they're worried about their jobs.
Yeah. Okay. And this makes sense. And you want this, right? Inflation is the big thing. Rates are the big thing. You need to see some demand destruction in order to get what you want.
We're not seeing it anywhere else. We're not seeing it at restaurants. We're not seeing it at hotels. I read the other day that like 90% of international travel on flights is already booked for the summer. Like,
Where are you going?
I'm not going anywhere, but there's not a lot of seats for anyone to go.
Man, I'm traveling internationally next week, not in the summer. Does that count?
Probably not counting you, no.
Okay, fine. Not good enough. That's fine. All right. Are you talking about this mutual fund thing, or can I talk about mine?
Go for it. You can start.
Mutual funds. Just kidding. Okay, so I think I may have brought this chart before, but I want to do it again because I like it. This sucker's talking about, we got a blue line, we got a green line, and the blue line represents the price of equities, aka the S&P 500, and the green line, represents earnings of those companies. And what this sucker is telling us is that equities, or the blue line, typically find a bottom 6 to 9 months before earnings reach their low. What are they comparing to? previous bear markets. So ultimately, we talk about this all the time, the idea that markets are forward looking and they're going to find and consolidate to a bottom before the headlines do, before unemployment does, before earnings do, and all that type of stuff. This kind of also falls in line with the idea that markets also typically bottom within the first third of a hiking cycle. So if we're on the back end of the hiking cycle, which I think is being signaled pretty clearly by Jerome, like it's very reasonable to assume, or might feel safe to assume, that the lows could have been in back in October, and we're just kind of going to tread water a little bit and slowly climb the wall of worries until we just get an absolute flash in the pan skyrocket, even though we're already 17% higher than the lows of last October. So again, let this serve as your warning that the markets are going to find a bottom before you think they're supposed to, right?
I mean, I wish that more people would listen to this, because I feel like we're going to look back on these conversations, whether it's 6 months or a year from now, and there'll be a lot of people still sitting on the sidelines going, man, I only wish that I invested 6 or 9 months ago. And I think just people have it in their brain that they're gonna be able to time it and get in before things turn around. And I think you're right. I think they're already late.
Yeah, but again, there's never too late, right? There's always get back in. There's not, oh, great, I didn't do it, so now I'm gonna wait for the bottom to come back, because it'll run away for you. That's actually perfect segue to this other chart, which talks about earnings falling and then the recovery. And if you look at this chart in all the pretty colors, all it's telling us is that earnings historically recover stronger than they fall. Markets do the exact same thing. You always recover to new all-time highs. And that's what earnings do also.
I don't think people look at it enough in that way. Like, I mean, we know it because the history is on the side that most years the market's up 75% of the time. Over a 10-year period, it's almost always up. But I think people seem to think that the downs come as fast as the ups and that they're just as bad. And reality is the down parts are shorter and not as bad, and the ups are longer and far higher.
Yeah, precisely. And then the last thing I'll say about all this stuff is, since October 12th of last year, the S&P is up about 17%, like I said. You know what's up 33% since then?
NASDAQ.
International markets, my friend. International markets.
Well,
That's
China,
it, brother.
China just released some fantastic GDP numbers yesterday, the day before.
China releases an astonishing number of astonishing numbers.
Right, but they were the last country to get out of COVID, and so you'd expect them to have phenomenal numbers, because first quarter was finally the year that people get out of their houses and start to spend money.
Yeah.
So thank God that you don't have all your money invested in the US, because there's a lot of places doing a lot better than we are.
Yeah, that's it. And look, if you've been only in the US for the past 15 years, good for you. You figured it out. You did it right. But it's not going to last forever. So everyone's on notice. So
last chart I want to go through is about, comes from a Wall Street Journal article by our friend Jason Zweig, or Zweig, I don't know how you pronounce his name.
Zweig, dude, Zweig. You had it, and then you...
Had a 50-50 chance. Jason Zweig.
Jason Zweig.
He put together an article, and I love reading what he has to say. The reason the pros don't beat the market, they can't beat you. And it starts off by saying from 1991 to 2020, they looked at mutual funds. Only 46% outperformed the market over that horizon. 24% over their full history, because some were not around that entire period of time. And one of the problems with mutual funds is that they have an expense ratio. So the average expense ratio is 1%. So you'd expect that those funds would underperform a benchmark because they have a fee associated with it. Unfortunately, human investors, while we don't have a fee associated with our funds, because we don't have a professional managing them, and usually you can buy an index fund or buy stocks without fees. We do very poorly because of our behavior. So that 1% the mutual funds charge, you can take off about 1% for the average investor. And so we're basically starting off at a near wash. That whether you do it yourself or hire somebody, you should come out relatively similar, because one has a fee but performs better, whereas one doesn't. But that's not the interesting part of the story, I think. The chart here is talking about how many stocks these funds own and how these funds do, depending on how many stocks they own.
Yeah.
So what shocked me was that the more stocks that a fund has, the better they do. And you would think, doesn't that just water it down? You just buy more stocks, just look like an index. There's no conviction.
Exactly.
So that surprised me. And the article's rationale behind why this is happening is that because, and we've seen this in the past, very few stocks actually provide the gains of the market.
Yeah.
So the number is about 4% of stocks from 1926 to 2016 have created all the gains in the US market. And so the less stocks you have in your fund, the less of a chance you have of finding those needles in the haystack and actually doing outperforming.
Yeah, I love that stat. The one that I had that covers a different time period is, I got it from the Spiva report. It's only 24% of the stocks in the S&P 500 outperformed the average stock from 2000 to 2022. Just Google positive skew and you can understand the statistical reason why that's the thing. That is interesting that the more things they hold, because that goes against the idea of conviction and concentration, right? Like even when we look at actively managed mutual funds, which we own, one, maybe two, for very specific reasons, you kind of want the concentration, right? You don't want what everyone kind of calls the closet indexer, because then you're overpaying for nothing.
Right.
So, man.
But to have a guy that's got 30 stocks and think that one of those 30 stocks is going to provide the boost. Really, when you talk about diversification, the average person would get by having more eggs in your basket.
Yeah, I know. It just, what stinks, and I think what people have a hard time doing because no one wants to be average is, look, if you can get the average return, you're doing better than the majority of people. But then that makes you average, right? But also not really, because you're doing better than the average person. So there's this kind of circular hedonic treadmill that becomes hard to avoid.
Well, as I say, I'd rather have beach umbrellas and rain umbrellas and own them both on a beach in Miami than only own one of them.
Oh, I'm in, dude. Let's behave our way to great investment results, Mr. Horowitz. I think we're done for episode 33.
Wrap it up. 34 coming up soon.
Yes, sir. See you then.
Have a good one.